Hello and welcome to this Wealth of Advice market update that we're recording on the afternoon of the 7th of April 2025. Deliberately waited till 3:30 on this Friday afternoon. The US markets opened up an hour ago and there's no getting away from the biggest news story in the world right now, and that's what Donald Trump has been up to over the last few days with his trade tariffs. He called the 2nd of April Liberation Day, and at that point he introduced a whole range of trade tariffs which we've got the chart that you can see on the screen right now, which has never happened before in history. Lots of economists and experts are saying this is kind of the end of the world free trade as we know it. There's going to be retaliatory responses from various countries. This morning the Chinese announced that they're going to put tariffs of 34% on a whole host of American goods starting in the coming days. And this, we think, is what Trump wanted. This is what Trump was expecting to happen, and it just confirms his whole brand of politics is chaos and create an absolute stink. And the only way to describe it, he's gone into the negotiating room and just flipped the table upside down, and he will want to see where the pieces land. So why has he done this? People are saying it's because he wants to get better trade deals for the US. He's hoping that other countries will come along and will ultimately give in to him, and the US will get better trade deals. He also thinks that more American companies, as a result of having to pay more for importing goods into the US, will open more factories and more plants in the harder hit areas of the United States. And that was one of his key things that he was voted in for. So it's not like this kind of wasn't expected, that he wanted to make America great again, as he keeps saying, and he wants the manufacturing output, etc., in the US to build up. But in the short term, it's going to cause chaos in markets, which you've absolutely seen this week. Markets have gone down. There's no hiding place from that. We've been in regular touch and contact with our various fund managers who invest all of our clients' funds, whether it be Roy London, the Elson guys. We've spoken to all those people over the last few days, as well as receiving various email bulletins and updates from those people. Yes, there's a lot of fear and worry in the market right now, and the markets hate one thing the most, and that's uncertainty. And the uncertainty is what will happen next with this. We've had a very choppy start to 2025. January was a positive month. That was on the back of December being quite negative. But then February and March was very, very, very poor. I did an annual review with the client this morning. When we looked at the 12-month performance figure for that client, he was actually up 1% over that 12-month period, because 2024 was a good year. We got some good returns. And I'm well aware there's clients who are watching this video right now who will be saying, well, I invested in 2022 and 3 years later, as a result of 2022 being so bad and 2025 starting in a negative fashion, they won't have made profit over that period, and we get that. One client sent me a screenshot a few days ago saying, why couldn't we just cash out on the 25th of January, which was when his portfolio reached what was an all-time high for him. And unfortunately we can't do that when we invest in clients' money for the long term. We're always looking at the bigger picture. If someone has a retirement plan of 15, 20, 30 years in the future, which is obviously unknown because you don't know how long you're going to live for, or if someone's saving for a specific date in the future, that's a bit different. But when someone's doing drawdown from a retirement fund, you have to remain invested. Yes, we changed the asset allocation, and the fund managers will be doing that behind the scenes. We're having a big discussion next Friday about the next quarterly asset allocation meeting, and it may be that we reduce the US slightly at that point, because there's going to be more volatility over there than other markets, it seems. Some of the biggest stocks in the world, Amazon, Tesla, Microsoft, Google, all these huge companies, Apple yesterday saw their share price drop massively. Fund managers might look at that and say it's a buying opportunity. Some fund managers might say, well, let's look to Europe, let's look to Asia, let's look to the UK even, to try and get positive returns. And overall, that's what we want to achieve in the coming period. It shouldn't be forgotten that over the last 5, 10, 15 years, the US market has dominated. It is the biggest market in the world with the biggest companies out there. I don't believe Jeff Bezos is waking up this morning thinking, okay, it's fine that the Amazon share price is down 10% in the last 2 days. He'll be looking for solutions to this. They'll be lobbying government. So all the big corporations in the US will be wondering what's going on and where this leads to. Like I say, the White House is hoping this tariffs results in other countries around the world coming to the table and negotiating, and the US will benefit. They believe that as a result of these trade tariffs, there'll be $600 to $700 billion a year better off in the future. Obviously, economists around the world are disputing that. but we just have to wait to see what's going to happen in the coming weeks. And hopefully, as I said, things calm down. And then if Trump does get his way, maybe the US will have to cut their interest rates in the summer. I think that's something he wants to do. He said in his lead up to the last election that he wanted more control over what the Fed does. Well, this certainly puts the Fed in a position where if it wants to stimulate growth, it will have to cut interest rates. And the Fed's got that awkward balancing act, if you like, of keeping inflation under control, but also wanting to stimulate growth. Well, if the tariffs do work as Trump wants them to, that will bring inflation. And I think a lot of American citizens will get very surprised at how expensive certain things that they've took for granted will come in the coming weeks and months. As I said, these tariffs are the highest that the US have charged going back to the Second World War. The baseline 10% tariff is what we've been told in the UK that we're going to have to pay, but other countries are possibly going to have to pay more. Immediately, Keir Starmer and his team in London are speaking with the US, trying to negotiate how we can get out of that. And the Americans, for instance, can't understand why the UK doesn't import like American beef, chicken, even fresh orange juice. That's produced en masse over there. We're not allowed to have because there's certain chemicals and other things that they put into their foods that we don't. So there's going to be big discussions on that in the coming weeks, and you might see a breakthrough. And once we see those breakthroughs, that's when we think markets will respond positively. We're given some examples now. The chart you can see on the screen is whiskey, for an example. Obviously, a lot of whiskey is produced in the UK and in the US. So this chart's showing how the tariffs on that would affect the different parts of the world that it goes to, and how those tariffs have changed over the last few years. Obviously, Jack Daniels and other bourbons and such like come out of the US. Scotland makes a lot of whiskey. There's a lot of whiskey made in the EU. So that's one key product, if you like, that you can put your finger on to say, well, how will this affect it, and what's the tariffs that's been charged so far. I was listening to a radio article last night where the Economist said the key thing to look at the coming days is probably going to be coffee, for example, because coffee is priced more daily. And he'll say, let's see how the Americans react when they go to Starbucks in the next few weeks and the price of a cup of coffee's gone through the roof. And that's what it'll boil down to with a lot of Americans. It'll be how will it affect them personally. They obviously believe that making America great again is going to be good for them, but the short-term pain might be something that they don't want to fail and don't want to incur. But putting America first was Trump's main presidential campaign focus. He wants to revive all these parts of the economy that people feel aren't doing very well. And as I say, he's going to follow that plan. Yes, it's chaotic and it's going to be a crazy couple of months. But as I say, let's see how this happens. Obviously, in the UK, British sectors that are going to be affected potentially by this are the car manufacturing sector. Obviously, Nissan up the road from our office here in Durham was already potentially in trouble. There's been some negatives coming out there in the last few months across the whole country for car manufacturing. That's been the case. Pharmaceuticals, it's not looking good. Obviously, the steel industry has obviously been affected by tariffs massively in the previous years. So it's not good. The US is already the UK's biggest trading partner by far. We were very confident after Keir Starmer went to the White House in February that he was going to try and negotiate a better trade deal. And this kind of just makes it all the more important to try and achieve that. So don't worry, we are keeping a close eye on things. Well, I'll say don't worry, I know all clients will be worried when they look at valuations and things aren't going up, they're going down over the last few weeks. But I'd say rest assured, we are looking at this and speaking with the right people, and we will make changes and be in touch if we think that's necessary. So as we come to the end of the presentation where we look at market performance and other associated areas, I thought we'd put on the patchwork quilt chart that I've shown many times over the years. And as you can see, bottom right hand square, the US S&P is the worst performer so far in 2025. And you look at where that's performed over the previous decade or so, it's normally up at the top. So the S&P is getting an absolute battering. We then look at which asset class and style return has done best and done worst. Commodities is the best area to be in right now, as well as value stocks, and growth is the worst affected area. Growth being the best area in 2024, 2023, even 2019 and 2020. And those were the big technology companies, like say your Amazons, your Microsoft, your Google, Facebook, Apple, etc. They were booming over those last couple of years, and those are the ones that have been really pulled back. So there's been a big shakeout as a result of these tariffs that Trump's imposed. The VIX index is something which we have shown many times in the past. That's obviously spiking up again right now because volatility and risks there. It's It's nowhere near the level it was back in the financial crash of 2008 or the COVID collapse of 2020. So hopefully, again, over the coming days, things calm down. The VIX index will reduce. Next chart showing what market indices have done since the beginning of the year. Europe, the best performing sector, followed by the UK, which, like I say, for those people who've watched these presentations in the past, that's not often the case. And as I reiterated from the previous screen, the S&P 500 from the start of the year is down 12.5%. S&P over the past 12 months, and obviously this chart was snipped before today's results are in, but over the last 12 months the S&P's effectively gone sideways, whereas the FTSE 100 was still up over 10%. FTSE 100 is down about 3% today, so again a lot of that recent growth is being given away. But if you look at some of those charts, we're just effectively moving back to where we were 6-7 months ago from a valuation point of view. And the chart that we always end on is look at the long term. 5 years, S&P 500 is still up well over 100%. MSCI World Index up 99% over that same period, and the FTSE 100 up 87%. So the gap between those indexes is reducing. And as I say, I am aware there's clients who will have been invested for shorter periods of time who are only experiencing volatility. But if you're retiring and you're taking drawdown from your funds, or you're saving for the future, it is a long-term investment proposition. And unfortunately, these risky moments and these risky periods do come along, and we just have to ride them out. Every fund manager we've been speaking to has basically said this week, put your seatbelt on and just accept the fact that the next few weeks are going to be very turbulent. As I say, I'm not overly concerned at this stage, because I do think there will be a solution to Trump's chaos, and that will be deals that will be getting done behind the scenes right now by world governments talking to each other. And in the coming weeks the outlook will be different, without a shadow of a doubt. Inflation could return, and we could have a change in interest rates, etc, etc. So thanks again for listening to the Wealth of Advice Market Update. As ever, if you need to get in touch with any of your advisor or paraplanner, anyone in the team, please don't hesitate to get in touch through the usual methods. Give us a call, drop an email, and we'll be back in touch as soon as we can.